What's up, everyone? In this video, we're going to be talking about how to survive a bear market. So a lot of people are learning that stocks don't only go up. It's been a brutal past couple weeks. If we look at the S&P 500, it's been basically nothing but non-stop selling pressure. Like intraday, it's just like every breakout that tries to happen just gets instantly rejected, and it's been really tough. And it's not just the stock market, even the cryptocurrency market is tanking in a huge way. Poor Bitcoin's right around $35,000 again, and just a couple months ago it was at 70 or just under 70,000. So it's been pretty brutal to say the least. In this video, we're going to explain how to survive this type of market, some important things to know given this type of market environment, and at the end of the video, we have a pretty important thing to know. So stick with me for that, but let's get right into it. So looking at the market over the past couple of weeks, it's been really tough, right? And a lot of stocks are selling off. One thing to keep in mind is that, if we just zoom out a little bit, the stock market, even though it's been pretty bad over the past couple weeks, it's still up a good amount, over the past couple months, the past year, the past 2 years. So it's even though the past couple weeks have been really bad, we're still up a really good amount. With that being said, that's the market overall. For individual stocks, it's a different story. If we look at Zoom, that's down a pretty decent amount over the past year. DraftKings, that's down a pretty decent amount over the past year. Palantir, Coursera, any individual growth stock is basically down, and even certain larger tech stocks are down in a pretty major way. Even if we look at Netflix, that had a horrible drop on Friday. It went from 700 down to 400. Peloton, down from 171 to 27. Even Square's taking a bit of a hit. So let's say you have shares of any company, right? And you're looking at it and you're probably just seeing it fall nonstop, and you're like, I don't like this. I don't like it. And you're looking at how to protect yourself. There's a couple different moves you can make, and it ultimately all starts with finding out where you have exposure. So step one, you want to find out where your exposure is in the market. For example, if you're holding Apple, Microsoft, and Nvidia, you have a completely different exposure than if you're holding Coca-Cola, Johnson & Johnson, and Procter & Gamble. Yes, they're all stocks, but they are very, very different. The first set of stocks are tech stocks, and the second set of stocks are value stocks, and they move in different ways. So let's say, like I said, you're holding Apple and Microsoft and Nvidia shares, and you're just seeing them fall nonstop, and you're like, how do I protect myself? I've seen some people suggest maybe buying put options on stocks that did not fall as much yet, like Coca-Cola, but that's a bad idea considering that while the market itself is kind of tanking down, Coca-Cola and certain other value stocks are rising up. So if you're looking to protect yourself, find out where you have exposure. And to do that, you might want to go on FinViz or, just find out what industries your holdings are in. So if you're holding Apple, Microsoft, and Nvidia, you have exposure to the tech sector. So you're not going to want to be buying puts on auto manufacturers. You would want to be buying puts on other tech stocks, or in just a better way, you might want to just buy puts on QQQ because these stocks that we listed are actually in the QQQ. So step one, if you're looking to protect yourself, find out where you have exposure. Step two, once you find out where you have exposure, you can either buy puts on the industry that you have exposure to, or you can short that stock. So in the example we gave, we could either look at QQQ puts, or we can look at maybe shorting the QQQ. If we looked at QQQ puts, maybe you go out a couple months or so and you buy an at the money put or puts that are a little bit out of the money. And in the worst case scenario, if the market just gets absolutely destroyed, at least you kind of have a hedge to protect yourself. In terms of hedging, put options essentially act as an insurance policy. And an example I want to give is with Palantir. So if we look at PLTR, this stock went from $30 down to $20, and now it's at $13.50. Let's say you're holding 100 shares of Palantir at $20 each, and you're like, I don't know if this is going to go from $13.50 down to $7 or down to $5, and you're nervous and you want to protect yourself. if you have shares of a company, you can protect yourself by buying put options, and essentially this just acts as an insurance policy. So if we looked at Palantir, you have 100 shares at $20 each, and right now it's at $13.50 each. You might buy like the 13 strike put for March 18th of 2022, and in the worst case scenario, whether Palantir goes to $50 or it goes down to $3, you will have the right to sell your shares of Palantir at $13 each. Now you have to pay a premium for doing that, which is around $123 each, but still, it acts as an insurance policy. So if you're holding shares of a stock, you can look at buying put options as a potential hedge, but it's also important to understand where your stock is. So for example, like if you're looking at a company like Coca-Cola, right? This stock is doing pretty well. It's been fine. If we're being honest, it's pretty close to highs and it's doing just fine. If you want to buy puts on this one to kind of protect yourself, that's fine because the stock is kind of already high up there and there's not a lot of panic with it. And implied volatility is, I guess you could say, it's moderate, right? Like if implied volatility is sky high, you don't want to be buying insurance on it because that means there's already a ton of panic. So if you are looking to protect the stock and implied volatility is relatively low and there's not too much panic in the stock, it's all right to buy puts. However, if you have a holding like Peloton where the stock went from 170 down to 23 and the implied volatility went from 56% up to 151%, it's kind of too late to buy insurance. And the main reason for that is because implied volatility is so high and the stock is already crashing down. So that's something important to keep in mind. Like if you were to buy puts on a stock like Peloton at this point, it's kind of like trying to buy insurance for a house, but the house is already burned down. Like it's too late. So just keep that in mind. Another thing to do is like if you have, I guess you could say, if you have like at least 100 shares of any company, you can do covered call options, which will pay you just a time premium for your shares, but we're not going to get too much into that because it's not a perfect hedge and now it's not the perfect time to do it. But the main important thing to know is that if you are holding shares of any stock, mainly shares, if you're holding shares of a company that is doing good fundamentally and that has true growth potential, like true growth potential, like not some penny stock that might do well in 30 years. Like if you're holding a company that solid fundamentals, they're a good company and they have true growth potential, you should be fine. We're seeing a lot of panic in the market right now and that is kind of dragging things lower than they need to be. So if you have solid holdings, you should be fine. Over the long term, fundamentals are what truly drive a company. Short term, there's a mix of things that drive a stock price. It could be, just sentiment. It could be bad news. It could be, just short-term selling pressure. It could be upgrades and downgrades, anything like that. But over the long term, fundamentals are what drive a company. So with that being said, if you're holding solid companies, you should be fine. But if you're holding riskier stocks like NKLA, it is a little worrying. So please be careful in that sense. For me, companies that I love, Zoom, DraftKings, AI is pretty good, Corsair is pretty good, Logitech's pretty good. Companies like that, I would say my top three would be DraftKings, Zoom, and then Square. So this doesn't mean that they're the best, but I just really like them. I really like their growth potential, especially I like their risk reward in this type of market. And I would say the most important thing to know with everything going on is whether the market continues to sell off in a major way or whether we even out for a couple weeks and eventually bounce back up. The main thing is to be buying solid companies. Fortunes are really made in recessions and times of panic. I'm not saying we're going into a recession, but the main point is that we are seeing a lot of selling pressure right now. And if we look back throughout history, like especially on the S&P 500, over the past 2 years, the people that had the best return trading the S&P 500 were the people who bought when times were the worst, right? And that was in March of 2020 when the pandemic was like really going on. So it's like, yes, there's a lot of fear right now, but that doesn't mean to just believe all the news articles you see and believe all the panic you see and just sell out of everything. Like if you think the market's gonna continue lower, by all means trust your gut and maybe close your positions. But over the long term, it is important to keep in mind that even with the short-term bad, like down fluctuations, if you're buying solid companies, you should do fine over the long term. And the best returns are made when people are most fearful, or when there's the most amount of fear in the market. So please keep that in mind. Thank you guys so much for watching this video. I really appreciate it. Let me know what you guys think on this market. Do you think we're going to head back down to like $400 on the SPY? Or are we going to bounce back up to $460? I'm very curious because, like, of course, I'm hearing a lot of I guess you could say bearish talk right now. But then again, I know there's a lot of people out there that I think the market's going to rebound in a pretty nice way too. So let me know what you guys think about this market in the comments down below. Besides that, thank you guys so much for watching and have an amazing weekend.